Hey, it's Mike. I am not an investing guru. I'm an average guy sharing my investment journey on the internet. In today's video, we're going to talk about investing in SCHD and SCHY for the last 6 months. We're going to talk about the return, the dividends, and my spreadsheet. First thing I want to go over is I invest in SCHD and SCHY in my Roth IRA. I believe that investing with a dividend focus in a Roth IRA is a better way to build wealth. Total portfolio value, $39,374.15. Of that, whatever gain I have, $3,575.61 is from earned dividends. Portfolio breakdown: SCHD 75%, SCHY 25%, and our funding. So we have invested in this last payment of $125 this week for Christmas. I will be fully funded for Roth IRA since 2019. So that would account for $30,500. Predominantly in the past, I used to own almost 50 to 100 different holdings in here. What I did is I would go through every single ETF, pick the top 10 companies in every single sector, and then I just stuck with that because that's kind of what the S&P 500 would do. And then I realized that's a lot of companies to be, making sure and checking up on. And so at some point in June 20th of this year, so around here is when I totally switched over, got rid of all my other holdings and switched to this 75-25 split. And so if you see here, where are we at? So June 20th, we started here. And for the most part, the share price has gone up, but then it's pretty much stayed stagnant up until just recently. And then the price has skyrocketed a bit. The thing about SCHD has pretty much been underperforming this entire year and for the majority of the pandemic. But, for a long-term investor like myself, these are actually really great buying opportunities where a lot of people are saying, oh my God, SCHD, what are we going to do? It's not performing. We need to abandon ship. No, that's not what you do. You get these dividends cheap. They have an amazing growth rate and you keep investing in it. So we're going to head over to my spreadsheet here, and I have a couple different rules when it comes to investing in my Roth IRA. So the rules is you want to do contributions to your Roth, and we do weekly deposits. And with these weekly deposits are supposed to add up to the Roth IRA max. So in 2023, I was doing $125 a week, which added up to $6,500, and I am in my final week to get that fully funded. Okay. I believe in 2024, it'll be $7,000 a year, which will come out to $134. Moving on, dividend income. So the focus here is dividend income and dividend growth. SCHD has been known to be a great dividend grower. Not only does it pay a decent yield, which, you don't want to necessarily focus on yield, but they have a pretty solid yield, but they have a really great dividend growth rate. They invest in really good companies. They account for many different things like their debt ratios, how much income they have, return on equity, and things like that. And from what I saw and through my web searching and researching, that it is a pretty solid fund when it comes to dividend investing. Moving forward, in my Roth, I just want to invest in ETFs, set it and forget. I don't want to be spending all this time trying to pick stocks here and there. Like that's what I do with my main portfolio. This is a Roth. This is a retirement account. I can't touch this money for years. So there's no reason trying to beat the market in this account. So, when it comes to my Roth and my 401k, I just stick to, the total stock market, total international, and set and forget it. And I don't have to think about it. Where I try getting my extra return is in my Robinhood account. But then the key here is to reduce turnover. The more an investor keeps moving things around, the more they lose money. So we just want to reduce turnover, set it. And then this is the set rate, 75% US, 25% international. So once I get my last dividend or last W-2 payment into this, or my weekly payment, I should max out it to the $30,500. The market value is $39,374.15. Total gain, dividends, market appreciation. Not going to read that to you guys, but I did some numbers here. One of the things that M1 Finance doesn't calculate well is your cumulative return rates. So my cumulative return over the last 5 years, so since 2019, 29.1%, which comes out to 5.82%. So, the stock market usually appreciates about 7 to 10% a year. We're not even close to that. I will say though that because the kind of value stocks have underperformed this year, that's one of the reasons why. But to judge a holding off 6 months is not an appropriate measure. So yeah, 5-year return rate 5.82%. But interesting statistic, the return rate or the return from dividends is 40.29%, which is pretty solid number. If you look throughout history, and I think the last 100 years, they say that, almost 70% of the return of the stock market has been from dividends. So, by not accounting for any dividend paying equities in your strategy, shooting yourself in the foot. But there's many ways to make money. Like there's not, one shoe doesn't fit all. So there's many ways that you can, build wealth. You can do it through dividends. You can do it through growth investing. You can do covered calls and options. Everyone has their own thing, but I like to incorporate a couple different strategies in my overall portfolio strategy. And then if you didn't, this is your cumulative return without dividends. So you'd be at 17.37%, and without dividends, so that's 3.47% a year. Terrible. So, with these dividends reinvesting in, it buys more shares, which give more dividends, which then those dividends grow over time. And then you create the dividend snowball. If you look over here into this aqua blue color here, so June is when I bought it, and we're here in December. So we had a pretty massive payment here in December because we had both SCHD and SCHY payout. SCHD is a quarterly payer, and then SCHY is a semi-annual payer. So that's why in September you only saw a smaller number, and then June, I think both of them paid out then. So this is kind of what we accounted for this year. And then moving over to this right side, you can see each year my dividend income has been increasing with the investment. There's a couple years here, these 2 years, they've been pretty much on par. I have been doing so much stock picking between those 2 years. And I just invested in SCHD and SCHY from the get-go, I'd probably be in a much better situation. But you live and you learn. There's some stocks that blew up. There's some stocks that did not. So you can't win them all. But as at least every single year, there has been some growth. In 2023, my yield on cost is about 4.97%. So if you take this number, by that number, you get 4.97. So if you're getting almost a 5% dividend on your holdings and you got $1 million, you're making $50,000 a year. That's solid money. Okay. And then just kind of going over the SCHD fact sheet. This is a highly rated fund. Very low expense ratio. Pretty much they track the Dow Jones US Dividend 100 index. And then they have a proprietary formula of picking some of their stocks. And pretty much what they do is they check return on capital, they check your debt to income ratios, and this is a 5-star fund. So, since inception has been, the yearly return has been about 12.53%, which is a little bit higher than the 7 to 10% total market return that you would get. I don't know what a Sharpe ratio is, and then your yield right now is at about 3.7%, which is pretty solid. So, you have your different stock breakdowns. Industrial and healthcare are your highest payers, with seems like Amgen and AbbVie being top winners. You got Chevron, Pepsi, Merck, Pfizer, Coca-Cola, Broadcom, Verizon, and Texas Instruments. So the thing about this fund is that the top 10 holdings make up 40%. Not a big fan of it being so concentrated, but if you look at the stock market as a whole, the majority of stock market return is always by the biggest companies and the best performing companies. So the fact that they're investing in the top 10 best ones, then so be it. And then SCHY is just the international equivalent. They use the exact same metrics. It hasn't been around that long to really show how well it is. In the last 20 years, the U.S. markets have been dominating, but who says that the U.S. markets will dominate the next 20 years? I believe they will, but you have to diversify somehow. And so investing in SCHY is that. And you can see here your top 10 countries that's invested in, as well as your breakdowns. And then so your top 10 holdings: GSK, KDDI, Toronto Dominion, Unilever, West Farmers, American Tobacco, Nintendo, BHP, Roche, Enel. So these are all your holdings. Again, top 10 make up about 40%. And the nice thing about investing in an ETF style thing is when one of these stocks is unfavorable, then the portfolio rebalances, they take it out and they put a better one in. So you don't have to do any of the work yourself. But just kind of going back over to the return again, the return it's not been that great looking over the whole portfolio. Looking at my dividend spreadsheet here, it's paying good income. Our dividends growing over time. I wish the market appreciation was a little bit better, but I've only been investing it for 6 months. I want to see what this looks like in, 4 more years, 5 years, 10 years. So this is a long-term play. And we'll keep dollar cost averaging here. So, every single week we put in that money, buys us more shares, and we will keep compounding our money. I hope y'all have a great video. I hope, these videos can inspire you to, get into the financial game, start investing some money, open up IRAs, take some risks, and then hopefully you can make some income for your family so you guys can live comfortably and live to the best of your abilities. Okay. Y'all have a good one. Take care.